It's hard to breathe, but that's alright. Hush.
Hey everyone, so I know I did a Wyckoff introduction and then I went on to the three laws, and now this is the Composite Man. I've probably spoken about them in a summary within the first video, but I wanted to cover up the Composite Man and explain a bit more in depth. Now, it's not going to be a very long video, it's going to be a couple of minutes, so listen up. So, Wyckoff created the idea of the Composite Man or Composite Operator as an imaginary identity of the market. He proposed that investors and traders should study the stock market as if a single entity was controlling it. This would make it easier for them to go along with the market trends. In essence, the Composite Man represents the biggest players in the market, so the market makers, such as wealthy individuals and institutional investors. It always acts in his own best interest to ensure he can buy low and sell high. The Composite Man's behavior is the opposite of the majority of retail investors, which Wyckoff often observed losing money. But according to Wyckoff, the Composite Man uses a somewhat predictable strategy from which investors can learn from. So let's use the Composite Man concept to illustrate a simplified market cycle. Such a cycle consists of four main phases: accumulation, uptrend, distribution, and downtrend. Okay, so what we'll do is we'll jump on to accumulation in the next video. So when it comes to accumulation, the Composite Man accumulates an asset before most investors. This phase is usually marked by sideways movement. The accumulation is done gradually to avoid the price from changing significantly. Uptrend, so when the Composite Man is holding enough shares and the selling force is depleted, he starts pushing the market up. Naturally, the emerging trend attracts more investors, causing demand to increase. Notably, there may be multiple phases of accumulation during an uptrend. We may call them reaccumulation phases, where the bigger trend stops and consolidates for a while before continuing upwards trend. As the market moves up, other investors are encouraged to buy. Eventually, even the general public become excited enough to get involved. At this point, the demand is excessively higher than supply. Moving on to distribution, next the Composite Man starts distributing his holdings. He sells his profitable positions to those entering the market at a late stage. Typically, the distribution phase is marked by a sideways movement that absorbs demand until it gets exhausted. And downtrend, so soon after the distribution phase, the market starts reverting to the downside. In other words, after the Composite Man has done selling a good amount of his shares, he starts pushing the market down. Eventually, the supply becomes much greater than demand, and the downtrend is established. Similar to the uptrend, the downtrend may also have a redistribution phase. So these are basically short-term consolidations between big price drops, and they may also include the dead cat bounces, or the so-called bull traps, where some buyers get trapped hoping for a trend reversal that doesn't happen. So when the bearish trend is finally over, a new accumulation phase begins. So Wyckoff schematics. The accumulation and distribution schematics are likely the most popular part of the Wyckoff's work, at least within the cryptocurrency community, as we mentioned earlier. And these models break down the accumulation and distribution phases into smaller sections, and the sections are divided into 5 phases, so A to E, along with multiple Wyckoff events, which are briefly described in the next videos. Okay, so again, guys, before I wrap up this video, I just want to say thank you for watching, and on the next one we'll be jumping into the accumulation schematics. So thank you for watching, guys, and I'll see you on the next one.